The title of the report, Global Insights, 5 questions for 2023. Your first question, let's answer that. Can the U.S. economy avoid a recession? What do you think?
Maybe, but it does seem unlikely, and that's really because of the economy seems to be heading for an iceberg in the form of higher interest rates. Those higher interest rates have really not taken effect as yet. For most borrowers, it's really the December 19th reference date. So as of Q1 2023, floating rate corporate borrowers are going to face debt service costs that are about 50 to 60% higher than they experienced just 6 months ago. So I do think we're going to see increased levels of financial distress among speculative grade borrowers. And of course, that's going to cause a lot of management teams to change their behavior. Rather than a growth orientation, they're going to start to think about cost cutting. And this seems to me precisely how a recession gets propagated.
And then, you still have the likes of some Fed speakers like Esther George, speaking and saying, she expects the Fed fund rate to be over 5% and stay there for much of 2024. What would force the Fed to pivot then, do you think, Jason?
Well, all this talk of a pivot really seems so premature, as you alluded. I think the Fed right now is very concerned that inflation is going to remain stuck above 4%. Inflation has come down, obviously. Price pressures have eased. The supply chain crisis is effectively over. But you still have lots of reasons to, again, fear that inflation is going to remain elevated relative to the 2% target. First, you have wage growth. At low skill levels, there is still significant labor shortages. Low skill levels, earnings are growing at about a 7% annualized rate. Overall wage growth, again, consistent with roughly 4% inflation. And then I think most consequentially, you still have management teams that got a taste for pushing price through over the past couple of years and are still looking to increase prices where possible. And I think really the only way for the Fed to deter those additional rounds of price increases is to impress upon management teams that those price increases are going to result in lost sales or lost market share. And again, the only way to do that is to further restrain demand. So on the whole, yes, I do expect another 25 basis points at the February 1st meeting, perhaps another 25 basis points thereafter. But that policy rate, 5.25% perhaps, is going to be sustained into 2024. And I think that's where markets are going to be very surprised. That could mean some additional upside for the dollar in the near term. But then also, again, more financial distress among speculative grade borrowers as they're forced to pay these higher floating rate interest costs for a longer period than they anticipate.
So, Jason, the key message then, as far as let's put it in the form of financial conditions. What's the investing environment going to be like first half and second half of this year?
Well, I think, first of all, in the first half, again, there's going to be a bit of a surprise as it relates to both the terminal Fed funds rate, but then just a clearer signal about how long it's going to last. And so I think that some of the people that are hoping for a rebound in technology shares, hoping for a rebound in some of the growth investment strategies that served them so well during the pandemic era are going to be disappointed. Of course, higher interest rates, the further your free cash flow arrives in the future, the more heavily discounted, so the bigger the impact. So I think it's going to be more of a value story for investors in the first half. And I think also investors going to have to start to think outside of the United States. Certainly allocations to Asia. I think that a lot of people that are maybe skeptical of the China rebound are going to have to be drawn in as more money comes in and asset prices move up in China. And I think that's going to be a really interesting dynamic to watch in the first half of the year.